Today, we're going to talk about the retirement tax torpedo. You may not know. Many retirees are surprised to find their tax bill far exceeds expectations on what they actually spent or withdrawn. The culprit, a chain reaction triggered when IRA withdrawals cause more of your Social Security benefits to become taxable. It's known as the tax torpedo. It's not a penalty, but a structural feature of how the IRS taxes retirement income. But first, the market wrap. Okay, Dow Jones Industrial Average closed at 53,842.33. Year to date, it is up over 12%. S&P 500 closed at 7779.73. Year to date, up almost 14%. NASDAQ 100 closed at 30,085.28. Year to date, up 19.16%. And gold closed at 4,369.99, and $369.99 per ounce. Year to date, up 0.77%. US dollar index closed at 99.66. Year to date, it is up 1.74%. 10-year Treasury closed at 4.66. Year to date, it is up 0.5%. And finally, the S&P Aggregate Bond Index closed at 228.76. Year to date, up about 0.33%. Okay, so here's how the IRS taxes Social Security. They have this equation called the provisional income formula. It consists of your adjusted gross income plus your tax exempt interest. Take note if you're getting a lot of municipal bond interest and the like that's tax exempt, and half of your Social Security benefits. There is a threshold. If you're single and you're below 25,000 for this equation, you pay nothing on your Social Security. And if you're married, if it's below 32,000, you pay nothing. After that, you might pay on up to 50% or up to 85%. So when you pull money from an IRA, whether it's because you want to or because the government's making you do it, it adds to your provisional income. Dollar for dollar, it may push you past some of these thresholds. And every extra dollar of IRA can generate up to $1.85 of additional taxable income if you make it to the 85% tier. This can cause your effective marginal tax rate to spike. And if you're in the 22% bracket, it can reach 40.7% for a marginal rate. And this is not a penalty or a mistake. It's a feature. Who gets hit the hardest? It targets middle income retirees most severely, those who save responsibly in tax deferred accounts their entire careers. So if you've got a large IRA or 401k that doesn't have the word Roth stamped on it, Social Security is a major income source, and you're going to be starting your RMDs at 73 unless you were born January 2nd, 1960 or after, in which case it'll be 75. The danger zone. Couples with combined income, 44,000 to 100,000, face the steepest marginal rate spikes. 1984, fewer than 10% of Social Security beneficiaries paid federal income tax. Now the Social Security Administration projects an average of about 56% of beneficiary families will owe tax on the benefits from 2015 to 2050. Taxable share of Social Security benefits rose from 12.2% in 1994 to 38.2% in 2022. Note these brackets were set in the 80s and the 90s, and they have not changed since. So let's say you've got a married couple. They saved diligently all their lives, and when they retired, they had about $1.5 million in traditional 401ks or IRAs, and they're getting a combined Social Security of about $84,000 a year. So by the time they turn 73, it grows to 2.6 million. And your first year RMD will be that amount divided by 26.5, which comes to about $98,114, give or take. It's fully taxable. They don't have a choice. Well, they do have a choice, but it's a bad one. It's even higher taxes or penalties. You add your $84,000 in Social Security income, Gets you to 182, 114 before any kind of investment income outside the IRA. So your standard deduction, including the senior deduction in 2026, your first 45,529 is not taxable. Leaves you with about 123,000 of modified it and a modified adjusted gross income of 169,514. Okay, so 85% of that 84,000, which is 71,400, is now taxable. 15% of that is going to be tax-free. 15% of the 84,000. So you get whacked with, if you have done no planning, thousands in unexpected additional federal tax every single year for the rest of retirement. So if you did some planning from ages 65 to 72, it can start earlier, but we're assuming they didn't start planning until they retired. You got lower income, and you don't have to take RMDs for those 8 years. What they can do is they can start converting $133,000 a year to Roth, shifting about 1.1 million at a blended rate below 24%. This gives you two things. Number one, it gives you a smaller traditional IRA balance, which means your RMD is going to be smaller because you got a smaller amount of tax deferred income. And you can potentially keep your provisional income below the 85% Social Security taxation tier. Large portion of Social Security remains tax-free. You stay below the IRMA thresholds, there's no Medicare Part B and D surcharges. Yeah, if there was no other income tax but Social Security, their federal tax bill would be about $2,624. With RMDs, the federal tax bill on the unplanned side is about $17,000. So, like I said before, for singles, the danger zones are 25,000 of provisional income to 32,000. Over 32,000, you're paying taxes on 85%. For marrieds, it's 34,000 to 44,000. IRMA, this is the important one, because if you go $1 over the IRMA threshold, in this case, this year for marrieds, it's 218,000 even. If that's your modified adjusted gross income, you pay nothing in IRMA surcharges. You get $1 more, and it's $81.20 a month in Part B, as in Bravo premium or surcharge, and $14.50 per person for a Part D premium. And it can escalate rapidly. As income rises, so do the personal surcharges. They max out at about $578 a month per person. Okay, now, important thing to know about the IRMA. Medicare looks 2 years back. So your 2026 income will set what your 2028 Medicare premium surcharge is. After December 31st of this year, there's nothing you can do to stop it. And then the torpedo zone. Torpedo zone is where these thresholds stack. You get Social Security taxation, higher brackets, and IRMA surcharges that all activate simultaneously. Okay, strategy one, do Roth conversions before the torpedo strikes. Pre-retirement, starting at age 63, you have to worry about IRMA, because when you're age 63, your income will determine if you sign up for Medicare at 65, what the surcharges are going to be. You can do Roth conversions at any time, but if you retire at 65, then your income is going to be lower, so you can start doing Roth conversions, favorable brackets. Delaying Social Security to 70 is good if you can do it, because if you're not collecting Social Security, you don't have to worry about Social Security taxation. After age 70, there's no reason to wait. And at age 73, RMDs begin. The conversions are going to be now less effective, and the torpedo risk is high. Okay, some other tools to diffuse the torpedo. Roth conversions are not the only tool. You can do what are called qualified charitable distributions. If you're already charitably minded, you can have $108,000 this year sent directly from your IRA to the charity. This will also satisfy your RMD if you're in RMD land. Tax bucket diversification. This has to be done in advance. The You need to have a combination, in my opinion, of taxable, tax deferred, and tax-free Roth accounts to control your income in any given year. Again, we talked about delaying Social Security. You can harvest tax losses in your non-qualified accounts. If you've got losses on things you want to sell anyway, go ahead and realize that loss and it'll offset some of your income. Pension and annuity income planning. Structure your guaranteed income sources to stay below that provisional income threshold if possible. And coordinate withdrawals successfully. Draw from taxable accounts first in early retirement. Let the tax deferred accounts grow more slowly. Okay, action steps. Know your numbers. Project your future RMDs using current account balances and expected growth rates. Map provisional income. Estimate where you expect to land relative to Social Security taxation thresholds at age 73. Model Roth conversions. Explore qualified charitable distributions if you're charitably minded. Review your account mix. And finally, most important one, work with a qualified advisor, an enrolled agent, a CPA, or a retirement income certified professional. I'm 2 out of 3 of those. I'm not a CPA. Okay, important questions. Every stage of your life needs a financial plan. Most important question in your working years, am I saving enough and is it in the right place? Will the USS glide path to retirement last 10 years? Will the USS retirement be shipshape when the day comes? Retirement, how do I avoid running out of money before I run out of life? And legacy, finally, does I work hard for get to where I want it to after retirement? I can be reached at herwirefinancial.com. I do in-person Zoom and phone appointments. I am licensed and registered across several states. Adding states is pretty easy. Schedule an appointment. Click on the Schedule an Appointment button in the upper right corner of the website. And please follow us and subscribe to the YouTube channel, Facebook, LinkedIn, and Twitter. For those who prefer the good old-fashioned telephone, 518-631-2569. Don't text that number. We'll both be sad because I won't get it. There's a separate texting number if you want to do that. Opinions voiced in this material are for general information only, not intended to provide specific advice or recommendations for any individual. All performance reference is historical, no guarantee of future results. All indices are unmanaged and may not be invested in directly. All data is believed to be from reliable sources. However, no representation is made as to its completeness or accuracy. None of this is to be construed as tax or legal advice. Consult your advisor prior to taking any action. This information is intended to be educational, not tailored to the investment needs of any specific investor. All investment involves risk, including loss of principal. Consult your advisor prior to taking any action. There is no guarantee a diversified portfolio will enhance your overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Securities Investment Advisory Services offered through LPL, a registered investment advisor, member of FINRA SIPC. All right, everybody, have a nice day, and I'll see you next time.